Central Bank held its key interest rate steady at 2.25% for this month. It was a widely expected move after the bank cut the rate by 25 basis points in August, but expectations are mounting over another cut in the next couple of months. Our Hwang Ji-hye has more.
The Bank of Korea has chosen to take a wait-and-see approach over the impact of last month's rate cut. It decided to leave the key rate steady at 2.25% in September during its monthly monetary policy meeting on Friday. The bank said although consumer spending is showing signs of picking up after being hit hard by the ferry disaster in April, the nation's business sentiment remains sluggish. The central bank governor, however, dismissed concerns that the Korean economy is headed for deflation.
Korea's expected inflation rate is running in the 2% range, and considering that, it's hard to say the economy is under deflationary pressure.
Experts say the bank could lower the rate once more before the year is out. They cite the domestic economy's still feeble pace of recovery, despite recent government stimulus measures and the central bank's rate cut that was intended to prop up growth. But another cut, they say, may not cut it.
The weak pace of recovery stems from the nation's structural problems, not because there aren't much changes in the key rate or government stimulus measures. So even if the bank lowers the rate, it likely won't have a major impact.
The central bank is also under growing pressure from the government to join efforts aimed at boosting growth. The government has been expressing concerns that the Korean economy might fall into Japan-style stagnation. Experts add, though, that the Federal Reserve's earlier than expected decision to raise its key interest rate due to the strengthening U.S. economy could be another variable down the road. Hwang Ji-hye, Arirang News.